I do appreciate everybody joining the meeting today. My name is Mitch Cook. I'm a retirement plan advisor here at Accel Wealth Management, and we're really happy to share kind of our next webinar series, Income Tax Planning. Plan for today, save for tomorrow. Today, I have one of my senior wealth advisors, Todd Monternock, joining us. He works with a lot of individuals and households and helping them prepare and implement income strategies. And a big part of that is how do we set those up today to make sure that we kind of save that impact tomorrow. So thank you for joining that webinar series today, Todd.
Hey, thank you, Mitch. Glad to be on.
Fantastic. Well, hey, before we kind of get into the presentation itself, just got a couple housekeeping items for you. First of all, if you do have any questions, definitely click on the Q&A box and type in your questions. We will save the answers to those questions for later since we are recording this series. Second, as we do go through, we will have some trivia questions. If you want to plug your answers into that same Q&A box, that'll help us kind of understand what you guys are all thinking. So just let you know, any questions that you have, we'll hold to the end. As always, this is an educational program, information purposes only. But if you do want to have more of an in-depth conversation to you and your household needs, we will have a survey at the end that you can definitely plug in and we would connect with you, whether it's just to answer some questions you have or get more into a comprehensive review for you. Right out of the gate, we're going to ask the first trivia question. What is the expected percentage that Social Security will cover for retirement income? Is it 1, 30%, 2, 40%, 3, 50%, or 4, 60%? So what do you think right now, today, what do you think the expected replacement of income would be due to Social Security? I'll wait a few minutes for people to answer that question because it's definitely a great question, and a big part of that leads into what we'll kind of talk about today. Well, for those of you, 40% is what the expected replacement is going to be from Social Security income. In the past, most people believe that it's about 50 to 70%, but it really has changed quite a bit. So I'm going to hand this over to Todd, and he's going to really go into more details on the options that can be reviewed for that additional savings that we need for retirement.
Thank you, Mitch. So when we look at that number, that Social Security is only replacing about 40% of our retirement income, that makes it really important for us to start saving for the future. And some of the reasons why that's so critical is we are living a lot longer today. If you take a look at life expectancies, especially when we look at married couples, there's over a 50% chance that one of you will live into your 90s. So it's possible today that you could actually be retired as long as the amount of years that you worked. So saving for retirement and putting it in the right buckets to create tax efficiency is really critical. Another reason that sometimes it's important to save is maybe physically you're forced to retire early. So getting started early on your retirement savings is going to allow you to hopefully be comfortable if something unexpected happens. And then with inflation, we always need to factor in that income is going to need to increase throughout our retirement years so that we don't see our standard of living continue to erode away because of inflation. The final thing that could affect us is you may have financial responsibilities for other family members. You may have some of your children that may need assistance, or it could potentially be that one of you end up in a care facility. That could have a devastating effect on your overall savings. So let's take a look at what are the different ways that we can save and what are the benefits of each of these. One of the things that I like to look at is retirement as a three-legged stool. And whenever you look at a three-legged stool, the more balance you get in each of the legs, the more level the stool is. Unfortunately, today, so many people push everything into the traditional side. And in doing so, you actually end up in the mercy of the tax code during retirement. So I'm going to spend a little time talking about each of these legs and what are some of the advantages or disadvantages of each segment that you might want to look at saving in. So the first one is your personal savings and investments. And a lot of this can be interest income, such as your savings accounts, interest on CDs, interest paid on bonds. When you're doing that, that's going to be taxed as ordinary income. So if you're in the 12% bracket, you'll pay 12% on that. If you're in the 22, you'll pay 22% tax on those earnings. Another segment on the investment side is long-term capital gains. So that's when you make an investment into either a mutual fund or an individual stock, and it's grown in value. And when you sell that stock, if you've held it for over 12 months, instead of being subjected to ordinary income tax, you're going to pay a capital gains tax on that, which is lower than what your ordinary income tax is. So if you're in a 12% tax bracket, your tax on long-term capital gains is actually zero. So there can be some great tax advantages in looking at capital gains as an option. If you happen to push into the 22% tax bracket, your long-term capital gain rate is 15%. So there's a savings on that. Well, when we talk about retirement, how can that be an advantage for you? I'm going to share an example. So let's say you're an individual who has either been investing in stocks and you've created a pretty nice stock portfolio and it pays dividends. If you own stocks and you've owned them for over 12 months and they pay dividends, that's considered a qualified dividend. So it's treated as a capital gain instead of being taxed as ordinary income. So let's assume you're retired and you've got income coming in and the dividends that your stocks are producing are still in the 12% bracket. You're not paying any tax on that income when you're retired. So there can be some huge advantages to that. Another situation, let's say you've been buying stock or you've got a company that allows you to purchase company stock, or you've received company stock either through a stock bonus plan or a stock purchase plan, and you've developed a really large portfolio in that stock, and it's done very, very well, and the stock is highly appreciated. Let's say you retire early and you want to start using those assets to allow your Social Security to defer and to continue to grow. So you start selling off that stock and it's the only income you have coming in. Let's say you sell you're married, and you sell $100,000 worth of that stock, and your cost basis or tax basis on that stock is $25,000. That's $75,000 of capital gain you have. You're in the 12% bracket. That's all tax-free. You won't pay any tax on that income as it comes in. So your personal savings and investments can be a very important leg when we look at our long-term savings, or even utilizing it to generate income while you're working, because you are going to get a tax break on those capital gains. Another advantage of that is to your heirs. One of the things that our current tax code allows is when you pass away, those investments, the tax base or cost base in that investment steps up to the current market value. So let's say you have an investment portfolio that you've invested $250,000 into, and when you pass away, it's worth $500,000. That tax base is going to step up to the current market value of $500,000. Your heirs are going to be able to sell that and pay no tax, no capital gains tax, no income tax on that. So there's also some advantages with that leg when we look at passing assets to heirs. Second leg we're going to look at is the Roth IRA, which can also be in a 401k, a 403b, or a simple plan. Many have an option for you to shift money from a pre-tax to an after-tax Roth account. Some of the biggest advantages of the Roth IRA is the tax-free growth that you continue to receive in the account. Now, you didn't get a deduction when you put it in, but all that growth is going to continue to grow. And as long as you wait till age 59 and a half, you're going to pull that growth out tax-free. So the advantage here is you've got a leg or a bucket to start pulling money out of at retirement time that you're not going to pay any income tax on. The other advantage of the Roth side from a tax planning and retirement, the income you pull from a Roth IRA does not count as provisional income in calculating whether you pay tax on Social Security. So it's not even in that calculation. Also, when you're retired, if your income is too high, you could see your Medicare B premiums rise also. Roth IRA income is not part of that calculation either. So when we look at the Roth, there's some huge tax advantages with that when you reach retirement and you start using those assets. If you happen to have a Roth IRA, during your working years, if an emergency comes up and you need to access that account, you can pull your contributions out of a Roth IRA prior to 59 and a half and not pay any tax or penalty on that withdrawal, as long as it doesn't exceed your contributions. You can then allow the growth to remain in the account and at age 59 and a half, pull that out tax-free. This is where a Roth IRA can also be an advantage when it comes to college planning for your kids or college saving. Instead of putting it into a 529 plan, which does offer an awful lot of advantages also, utilizing a Roth will allow you to use that money for retirement if your children don't need the funding to help with their college or their tuition assistance. So there's some really good advantages when we look at the Roth side. There's also a huge advantage at death when it goes to your heirs. When you pass away and it goes down to the next generation, your heirs can move that into a beneficiary or inherited Roth IRA account. They will be required to take minimum distributions out, but it will be very, very small in relationship to the value of the account, especially depending on the age of the beneficiary. That allows them to continue to allow that Roth money to grow and accumulate for up to 10 years. After your passing, the account must be liquidated within the 10th year, but they can at least take the minimum distribution out and let it continue to grow and get a much larger tax-free benefit at the end of the 10th year. So here again, like capital gains, Roth IRAs also offer a nice advantage when we're looking at legacy planning for our heirs or that next generation. The third leg we'll talk about is the traditional, which most people are familiar with. I put money into this account, I don't pay tax on it, or I get a tax deduction on it when I put the contributions in. The advantage is it grows tax deferred. The only disadvantage is when you go to take the money out, you are going to pay tax as ordinary income. Traditional IRA income or 401k income at retirement also counts in provisional income when you're calculating whether you pay tax on Social Security. It's also in the calculation as income in determining whether your Medicare B premiums may be increased also. So unfortunately, too many people overload the traditional side, or that's the only leg of the stool they're using for retirement. And when that happens, unfortunately, you're at the mercy of the tax code when you start taking that money out, because everything you take out of that account is going to be taxed as ordinary income. That's one of the reasons we like to see balance in this three-legged stool. It gives you the option to either utilize the traditional, the Roth, or the personal savings when you're either doing income planning or large purchase planning in retirement. So if there's any way you can create balance, you're going to have an advantage when we take a look at playing the tax game. With a traditional IRA, at death, when it goes down to the next generation, they are allowed to put that into a beneficiary or inherited IRA account. Again, they will need to take minimum required distributions out, and the account will need to be liquidated within the 10th year. So depending on the age of the beneficiaries when they receive it, they do have 10 years to try and do some tax planning to figure out how they should take it out and what's the best way to take the money out of that account. So not that there's anything wrong with the traditional side. If you do end up in a lower tax bracket at retirement, you are doing tax leveraging with the traditional side. If you're making donations, or not donations, but contributions into the traditional side, and you're in a 22% tax bracket, and when you retire, you're going to be in a 12, you're getting that tax leveraging by taking it out at a lower rate. It's just, in our opinion, it's important to have a balance between all three of these. So now I'm going to turn it over to Mitch. He has another question for everybody.
Yeah, no, and I know, Todd, there's definitely a lot more items with the three-legged stool that can be discussed. But my next question. So which savings option offers the best potential tax advantage? 1, 401k, 403b, 2, traditional IRA, 3, Roth IRA, or 4, a health savings account. So if you want to put your answers in the Q&A box, click on there and kind of put in the answer 1, 2, 3, or 4, and let us know what your thoughts are. And in a little minute, I will let you know. Okay. Well, this one's kind of a little bit of I won't say a trick question, but it's actually a health savings account, HSA. And we want to make sure we bring this up for a number of reasons, but really the biggest one is, well, how do HSAs offer the best potential tax strategy? Well, they have something called a triple tax benefit. Todd was highlighting, on that three-legged stool, when you take a look at whether you're doing traditional or Roth, both of those have good, valuable options. But when we look at a health savings account, the biggest thing we look at is the money goes in as a deduction, deferred. So similar to a traditional, it grows very similar to a traditional and a Roth. So it grows tax deferred. But as long as you use the health savings account for qualified distributions, healthcare expenses, medical expenses, the distribution is tax-free, just like a Roth. And when we look at retirement, and we look at the rising expenses that we're seeing in retirement due to healthcare and medical expenses, and as we plan for that, we're estimating a married couple retiring today is going to have anywhere from $300,000 to $400,000 just in medical expenses through retirement. So when we look at the biggest tax strategies, such as a health savings account, it may be one of the best options to help save and offset some of those healthcare expenses we're going to see in retirement. So whether you and your spouse are able to utilize this as an option while you're still working today, this is definitely something we want to make sure that you understand the benefit of this health savings account. So if you are contributing to an HSA, you're eligible in that, but you're not maxing out the contribution, you may want to revisit that and maybe look at how you're contributing, whether to your 401k or even outside to IRAs, and really hone in on utilizing your HSA as a retirement savings vehicle. And here are the maximum limits. So if you're self-only on a high deductible and have the ability, it's $4,300. If you're part of a family plan, you can put up to $8,550. And then if you're over the age of 55, you can do an additional $1,000 above that to contribute into these health savings accounts. Now, one of the things that we get questions on, well, my health savings account is set up through a bank and it's going into really a low interest type of an account. Well, one of the things that we want to make sure that you're aware of over the last 5 to 10 years, we're seeing health savings accounts being able to invest very similar to your 401k, 403b, or even an IRA account. So there's a lot more opportunity to invest that into a mutual fund or some type of an investment account. So that's one of the areas to take a look at. If you've created a pretty good amount into a health savings account, that's something to explore and maybe look at outside of maybe the bank that you're utilizing. There's definitely some great options out there. One of the things to also consider, and this is something that we help our clients with, is a one-time tax-free transfer right at retirement that you can make a contribution up to the limit in that 1 year into that health savings account. There are some limitations that you may have applied to you in that last year, but that is something that can actually go in as well. So if you do have any questions on how this can be done, whether putting it into some type of investment account, definitely feel free to contact us. We'll have that survey at the end, and we can definitely discuss how that can be set up and work for you. All right, I'm going to move it back over to Todd here, and he's going to go into kind of a secondary thing to take in consideration before you really look at that retirement income.
Yeah, just a quick add. Anytime doing retirement planning with clients, if they've accumulated a nice nest egg in their HSA account, that goes a long ways to helping them having a nice, comfortable retirement, knowing that they've got that there to take care of some of that medical expense. I know we talked about the traditional and the Roth. I'm just going to give a quick summary of the differences between them. So if we look from the traditional side, it's all going in pre-tax. Roth goes in after tax. The growth of it on the traditional is going to be tax deferred. The Roth, we consider it tax free because as long as you wait till 59 and a half, it's going to come out tax free. So your traditional side is going to be taxable. Roth IRA is going to be tax free. When we look at required distributions, you have to take money out of that traditional side once you reach age 73. With the Roth IRAs, you are not required to take required minimum distributions. The other advantage when we look at from passing to the next generation, the traditional is going to be taxable when it goes to your heirs. The Roth IRA is tax-free. You do have the ability to do inherited. Both of them, the accounts can last 10 years. Both of them, you are required to take minimum distributions out. The difference is everything coming out of that traditional side is going to be taxable. Everything coming out of the Roth side is going to be tax-free. The other difference is the traditional income is going to count towards provisional income. It's going to count towards taxation of Social Security, could affect your Medicare B. The Roth is not. So the big question, if you are retired or approaching, depending on your income, should you consider doing a Roth conversion? Should you consider a Roth conversion strategy? So I'm going to flip to the next screen here and talk about some of the consequences from a tax standpoint with traditional versus Roth. So if we look at the current tax code, you'll notice there's a big difference between your tax rates if you're filing single versus if you're married and you have the ability to file a joint tax return. If you look at the 12% bracket for married couples, it's twice as high. Also, when we look at your deductions, the standard deduction from single to married is double. And then if you're over 65, you get some additional deductions on that as well. So how does that affect you from a tax standpoint? If you could click, Julie. So if we look at a married couple, let's say they both are receiving Social Security. One of them has a pension. They have required distributions that need to come out of their IRA accounts. In this assumption, we're assuming that their combined IRA values $929,000. So if we look at this scenario, the taxes that they would pay as a married couple. So their taxable income at this point would be $95,000. Total income, taxable 47. they're paying $5,166 in federal tax. If all of their IRA money were Roth, they'd pay zero federal tax. Even pulling that $35,000 out, they'd still pay zero federal tax. One thing that a lot of people forget or don't take into account is what's the impact on my spouse if one of us dies. So I'm going to show you the same scenario, only now one spouse has passed away. So the survivor gets the higher Social Security. They took 100% benefit option on the pension, so that stays at $15,000. Doesn't matter what the value of the account is, the RMD is going to be the same. So there's still $35,000 coming out of the IRA account. So let's take a look at the tax situation now. Total income goes from 95 to 75,000. Their taxable income goes from 47 to 54. Now they're filing as a single person. Federal taxes are now $6,849 as opposed to $5,166. Quite an increase. If all that 929,000 were in Roth IRAs, the survivor would pay zero federal tax. So when we look at planning for retirement, you not only need to take a look if you're married, is what's our situation look like if we both stay alive for a long period of time? Huge tax advantages. What if an unforeseen event happens and one of us passes away? The tax consequences to the survivor can be significant. So when we look at long-term planning, we want to take a look at both of you staying alive for a long time, but also the unexpected event that one of you passes away early. And how do we help set these accounts up so that the survivor doesn't get hit really hard with taxes? So when we look at what are some of the consequences or things that we need to take a look at when discussing Roth conversions, you need to take a look at your life expectancies. And you need to be honest about your health, your lifestyles. Who do you think is going to live longer? If we look at normal life expectancies, male typically passes away first. And as we showed in the prior illustration, we'll call it the widow's tax. The surviving spouse can get hit with a much higher tax. Also, what state do you live in and what are the consequences of doing conversions? Fortunately, in Iowa, they changed the tax code on taxation of IRAs. So if you're over 55 years old, you do not pay tax on IRA withdrawals, and you do not pay Iowa tax on Roth conversions. So that's a tax-free conversion in the state of Iowa. The other thing to take a look at is the tax code. Tax code's only as good as the current administration in office. Tax policies continue to change. Right now, the current tax code is changed to sunset in 2025, which is the end of this year. If they don't do an extension, it's going to revert back to where it was, and most of us will see an increase in taxes. I don't foresee that happening. I believe they will probably extend the current tax code. You do also have an option in your 401k to do conversions inside of that. You just need to take a look at what makes sense today, or does it make sense to defer that conversion until after you retire? If your income is lower at that point, we may have an option to do more conversions at a lower tax bracket. So when we look at conversions, a lot of what we're looking at is bracket maximization. So if you're in the 12% bracket, how much can we convert to keep you in the 12% bracket so that you don't flow into the higher bracket later on? Also, charitable giving can come into play in retirement. Donor advised funds. Most retirees are not going to itemize, so you're not getting a big break on charitable giving. If you are very charitably inclined, it may be advantageous for you to set up a donor advised fund and make large contributions into that periodically so that you get the tax deduction, and then use the donor advised fund to make your charitable contributions. Another thing to keep in mind is when you do reach 70 and a half, you can start utilizing your traditional IRA to make charitable contributions, and that's non-taxable. The big advantage there is when you hit age 73 and you're required to take minimum distributions out, you can shift a portion or all of those distributions to a charity and not pay any tax on it. You are allowed to contribute up to $105,000 to charities out of your IRA and not pay tax on that on an annual basis, and that is indexed with inflation. The other thing is timing your withdrawals, having money into an IRA account. So sometimes consolidating all those retirement accounts into traditional IRAs gives you a little more control to manage out how some of those withdrawals come out. When we also look at making conversions, sometimes market timing, when the market's down, you've got holdings that you firmly believe are going to bounce back. Converting them when the markets are down at a lower rate is going to create less federal tax. And then as the holdings bounce back, you get all that gain in your Roth account that you're not going to pay any tax on. So there are some really good strategies when we look at doing Roth conversions. Most important thing is work with somebody who understands the rules, which we believe we have a pretty good knowledge of that and can help you out. With that, I'm going to turn it over to Mitch and let him talk about some of the future action steps you might want to take a look at.
No, thanks, Todd. I think with the conversion aspect, as Todd pointed out, definitely working with somebody that understands how the conversion works, but when to best implement those strategies. And while we are not CPAs or tax advisors, understanding the liability that happens with these type of strategies is very important, because we usually want to look at strategies that'll keep you in a lower tax bracket when those conversions occur. So some of the big action steps that we want to make sure to highlight. Todd had mentioned the three-legged stool and really looking at that diversification of each one of those buckets. Each one of those is going to offer advantages through retirement and helping you succeed on when you want to take certain income out of there, and also taking advantage of those future tax benefits. And it ultimately comes down to control. Giving you that control and that freedom to be able to utilize that income the way you want it to work, which really understanding your personal tax situation is going to be a key part of that. Where are you at today? How is your overall taxes going to evolve over time? And how could that potentially impact the day that you do want to stop working and turn on the future income, which then leads to determine what those income needs will be in retirement. What are your goals? What are your objectives? And what are you looking to accomplish as you do retire and you want to enjoy that new freedom? And if you haven't done so, definitely create and implement a financial plan. Just at least starting to formalize what are some of those key puzzle pieces that you would like to have in place. And it will evolve over time. That's okay. There's always detours or changes that occur, but it's just understanding how that could potentially impact what that future is going to hold. And then for us, we're here to help. Whether it's scheduling a 30-minute meeting to help answer questions or go through more of a comprehensive review, we're here to offer a complimentary discussion with you and your household. So it doesn't have to be you individually if you want to pull in your spouse. Our next webinar series is Estate Planning 201. For those of you that may have joined the first one, Estate Planning 101, where we went through kind of the basics of protecting, managing your assets with a high level of understanding wills and trust and healthcare directives. This one's going to get a little bit more in depth in understanding how to manage your estate through the different types of asset protection strategies and legacy planning. So that'll be what we have coming up here on our next financial roadmap series. If you do want to go back and take a look at our video library, you can definitely access that information through accelwealthmanagement.com/video library. That concludes our financial roadmap series today. As I mentioned, if you do have any questions, definitely plug it into the Q&A box. And we'll wait at least a minute here to see if we have any questions that come up. And it looks like we do have a couple questions. The first question is the $300,000 to $400,000 in medical expenses in retirement. Is that per person? No, that's for a married couple. The individual is basically a half, so about 150,000 is what we look at when we take a look at additional medical expenses. And this is going to be above what what Medicare is going to cover. This can include that Medicaid premiums. This is really going to include those out-of-pocket expenses, prescriptions, things that you're going to be paying out of pocket. That is what the estimates are coming in at. Another question. I have a simple IRA through my workforce. Are those convertible to a Roth in the same way as a traditional? Yes, with a caveat. As long as you've had that simple IRA for at least 2 years, you will have the ability to convert it as if it was like a traditional IRA. So you will have that ability to be able to convert that over to a Roth IRA. And for those of you, if you are actually in a simple IRA today, depending on who you have that program through, you do and may have the capability to actually start investing into a Roth within your simple as well. So just know on a simple IRA, you need to have that money at least seasoned for 2 years from the first contribution that went in. As long as you're past that 2-year period, yes, you can work on doing that conversion. I believe that was the end of the questions. As I mentioned, after we get done with the presentation today, you will have the opportunity. Oh, it looks like I have one more question. If I have an existing Roth IRA, I've had it for over 10 years, can I convert portions of my 401k to it? And are there limits on how much I convert at the time? Great question. So for your 401k, the question really with that is, how long have you been in the 401k and are you still employed at that company? Because there's 2 ways that you can potentially convert 401k money. As long as the 401k offers it, you can convert it within the 401k plan itself. So if you have traditional money inside the 401k, you could convert it inside the 401k to a Roth inside the 401k. If you're no longer employed or you're over age 59 and a half, you can definitely convert that money into the 401k out to a Roth IRA. And there is no limit on how much you convert. But that's where the tax question comes in. Whenever you convert money from traditional to Roth, it would be considered like ordinary income. So if let's say you converted $100,000 of traditional to Roth, it would be like you're reporting $100,000 in ordinary income. So we try to do those conversions to maintain you in that lower tax bracket. I don't know if Todd, if you wanted to add any commentary around that.
Yeah, there was a follow-up. He indicated that he is retired and there's no Roth option in the 401k. So the way to do a conversion would be to move some of the 401k into a traditional IRA, which is a tax-free rollover, and then convert it from there into the Roth.
Yep, I think that's a great point to make. As if you're retired, you're over age 59 and a half, you want to do those conversions. One of the cleanest ways is move it out into that traditional, and then it could be a lot easier to convert it to the Roth. Another question. My son has an HSA through his work insurance through Optum Bank. Can he convert that to another choice of investment? There is that possibility. Your son would want to contact the HR to see if that money can be put into another type of investment solution. And that would be a first place to check. There are a lot of great HSA options available. A great example is Fidelity has an HSA option available. It would be asking that HR team, could he deposit that? Most HSA accounts you can transfer to those other type of strategies, but typically starting with the HR to see if there is that investable option is a great start. All right, great questions, everybody. When my husband and I considered an HSA, our high deductible premiums were not much lower than the regular healthcare premiums, but the coverage of the medical expenses was much worse. So we would likely end up using all the contributions up to cover medical expenses. Is that the case if there is still a benefit of an HSA? I mean, when looking at the different health insurance plans, you definitely want to make sure which one is going to be providing the better benefit for you. Uh, Typically, those that tend to have a better value with the HSA or high deductible plans are usually those that are younger, don't have as many expenses, whether it's for prescription or doctors or certain visits, where you aren't paying full amount out of pocket. So the first step is always determining which healthcare plan is always going to be the best, number one. So what you shared with me, I would agree. If you had better coverage with the other option, is likely going to be the better approach. But if it is determined, you get to a point where maybe that there is a more higher cost value with that HSA option, that's definitely where you want to then consider maxing out that HSA account and taking advantage of the triple tax benefit and the potential is using that as a retirement asset. Okay. That was the end of the questions. As I mentioned, there is going to be a survey right after this. So if you do want to either follow up with more individualized questions, schedule some time with us, or even look at more of doing a comprehensive review, fill out that questionnaire and we'll be in contact with you. On that note, I appreciate everybody joining today and hopefully keep our fingers crossed the weather will not be as drastic as what they were predicting. Thank you again, everybody. Have a great day.